Hi, welcome to Daramola Talk Finance. On the episode of today's video, I'll be talking about the difference between investing and investing in a fund. And I know it's been a very long time I came on this platform to share my video, and I'm very sorry. That's because I'm a lot busier and these questions have been coming up regularly, and I think it's important that I address it. So I've written down some things on my notes and my screen, so I'll be trying my best to explain all the questions you may have between investing and investing in a fund. Now, I'm going to be talking about the difference between investing and investing in a fund. I'm also going to be talking about the risks and the reward between these two things. I'll be talking about how to buy a share or stocks. I'll also be talking about how to buy a fund and types of fund, and I'll be talking about compound interest strategy with your fund. Now, this is going to be very unique. So you may do it to get your pen and your book so you can write down these things. So when you're making your next investment decision, you're informed based on this information that you have so you can make the right investment decision. So why is this very important? That's because there's been an euphoria with investment that is happening everywhere. So everyone wants to invest, but a lot of us don't know actually what it means to invest. So that's the reason why I will be talking about this. And at the end of this video, I'll be giving you a very good example of a fund that you can actually pick and see how that fund is going to perform with the compound interest strategy. So watch through. Everything in this video is very important, so watch through and don't skip any. All right, so if you're interested in learning more about investment, business, and finance, follow me on Daramola Talk Finance and watch my previous video. You'll be well to get yourself informed with this important concept about investment, business, and finance and trading, and that'll do you a good way of getting yourself abreast with what invest by buying an individual company. So you can invest buying individual companies. So we have companies that are publicly traded. So you can buy the shares of McDonald's, you can buy the shares of Procter and Gamble, you can buy the shares of Microsoft, you can buy the shares of Tesla, you can buy the shares of Nvidia. So these are different publicly traded companies. So you can decide to buy the shares of this company rather than buying a fund. So what is a fund? Is a basket of companies that is in it. So this time around, you're not just buying an individual company, you're buying a basket of company. Now, when I talk about the risks and the reward, I'm going to give you the difference again for you to understand the risks in buying a fund and the risks in buying a individual company. All right, so what's the risk of buying an individual company? For instance, you can decide to buy Tesla, or you can decide to buy Microsoft, or you can decide to buy another company, right? Now, there's a probability that the company you bought may not perform well in this year, 25, for instance. So maybe the company you did not buy performed well. So that's the risk because you don't know the company that is going to perform well. And for you to make this informed decision, you need to understand about the financial statement of the company, the cash flow statement, the profit and loss account. You need to understand the balance sheet and all of that. Those are somehow or somewhat confusing, although it can be explained, and I've do well to explain some of it in my previous video, so you should do it to watch them. But however, you need to be maybe you need to understand what it takes to read and analyze a financial statement before you can actually buy an individual company. All right, so that's the risk that is involved. For the reward, is that it performs very well. You can decide to buy Microsoft, and Microsoft maybe perform 30% or 50%. So you've made 50% return on investment. In other words, you invest £5,000, you've made 10,000, you've made, sorry, £2,500. That's 50% good money for investment. However, the risk, like I said, will be offset if you had bought it. A fund is buying the basket of companies. So you're not buying an individual company, rather you're buying basket of about, let's say, 10, 50 companies that is in that basket. In other words, you're buying the average performance of these companies. So if you have 50 companies, you add the performance of this company, you divide them by the total number. I mean, how to calculate an average. So you're getting the average performance of the company. So that's the risk and the reward involved with buying an individual company or buying a fund. The next I'll be talking about is how to buy a share and a stock. Now, what's the difference between a share and a stock? A share is just an individual company. A stock is a portfolio of companies that you own. So you have company, you have a portfolio that have a share in Microsoft, Nvidia, Tesla. You have it that have with Mitsubishi. You have different publicly traded companies. So you have shares in these different companies. So the combination of it is your stock portfolio. So that's the difference between a share and a stock. So how do you buy a share or a stock? Now we have different brokers that gives you the opportunity to buy a share and a stock. We have trading to in the United Kingdom. We have different types based on the country you're staying in. So you do it to make your research, know what suits you, and the broker that is accredited by your country. In the United Kingdom, we have it accredited by the Financial Conduct Authority. So you want to make sure that your broker is registered with the FCA. If there's a chance for liquidation, you still have some percentage of your money that will be given back to you. And by the way, this company will be regulated, so there's no fraudulent activity with your money. So Trading 212 is the company or a broker I promote so much because you have the opportunity to buy shares from different parts of the world. And guess what? It as little as £1, $1, whatever amount you're spending in your country that allows you to open an account with Trading 212, you can start investing immediately. So that's very simple. So get a broker, register with the required documents. And I've talked about this in my previous video on how to open an account with a broker. So once you open it, you deposit your funds, then you start investing. It's as simple as that. Now, the next is how to also open a fund. So Trading 212 also allow you to open a fund. It's called Stocks ISA, Stock Investment Savings Account. Now, in the United Kingdom, you can invest up to £20,000 tax-free. So if you have £20,000, very few amount of people will invest above £20,000, except you are a high net worth individual, so you can invest up to 100k, £200,000, and all of that. But as low as £20,000, you won't be taxed for any profit you make on that account, right? So the next thing is we have different kinds of funds in Trading 212. We have Vanguard S&P 500, we have FTSE 100, 250, we have ESG All World Index. These are different kinds of funds. So, and I've talked about fund mix also. So we have a fund that has a combination of both bonds, both cash and equity. We have a fund that is just basically equity. We have a fund that is basically on bond. We have a fund that is basically on cash. All right. If you don't understand this, just comment below what's the difference between this stuff you just said, and I'm going to explain to you as fast as I can. So we have how to invest in shares, how to invest in fund, and Trading 212 allows you to do both. Right. In Trading 212, we have four types of accounts. We have CFD, contract for difference. We have Trading 212 cash ISA. Instead of you investing your money or keeping your money rather in your savings account, where inflation is eating up the value of your money, you can actually invest your money in Trading 212 cash ISA. They pay 4.9%. That is the best out there, guys. The best out there. So in Trading 212, your money will be working for you, especially if you're paying rent in 1 month time, or you want to buy a car, you want to buy a house or something in the next 4, 5, 6 months. You can actually put your money there and it's working for you, like it is working for you. Good. Next, I'll be talking about how compound interest work with your fund, and I'll be showing you on the screen. You see a compound interest calculator. I'm going to give a link below in the comment section how to know how your fund is performing. For instance, like I promised, I'll show you a fund in Vanguard. You can find in Trading 212 that in this fund, as you're seeing on the screen, you look at the performance of this fund in the past 5 to 10 years. Now you add this performance. Now, when you add this performance, this is a fund I invest in personally. When you add the performance of this fund, now you divide it by the total numbers of years. It's going to give you an average. Now, you want to put that in the calculator. Let's say, for instance, if you add this fund I'm talking about, you do the calculation yourself so you understand it, how it works. So let's give a figure, for instance. Now, this is not exactly how it is, but I'm just giving you a figure. This is going to help you in your calculation. So let's say when you add 10 years performance in the past 10 years, this is 25. So from 2015 to 25, or from 2014 to 24, it's 10 years. And this investment have been performing, let's say 2014, it performed 10.9%. 2015, it performed 30%. You get the point? So you add this number together and you divide it by 10. Let's say, for instance, the average is, let's say, 10%. Now, when you go to your compound interest calculator, I've highlighted the link below in the comment section. When you go to the compound interest calculator, it will show you your initial deposit. For instance, this fund, you have an initial deposit of let's say £100, and a monthly deposit of, let's say, £200, right? So, and you're contributing this money monthly. So it's more like you're contributing the money monthly every month. There's a direct debit that is taken from your bank account into this fund, right? So you want to be doing this for the next 30 years. And when you put in this figure in the compound interest calculator, you'll be surprised to see the value that it will generate, right? That is the magic of finance compound interest. So if your goal is to retire a millionaire after 30 years, then you want to do the calculations. If I'm investing £200 every month, can it generate me, with this average performance of this fund, can it generate me £1 million? If it is no, then it means you have to adjust your strategy, or you have to pick a fund that suits you. But this is a fund that I invest in, and I feel it's good for me based on my age, based on my risk tolerance, and I've talked about this in my previous video. So I'll be stopping here. If you have any question about how to invest in a fund, a bond, whatever it is, just comment section below, and I'll maybe highlight one of my videos that I've explained it, or I'm going to do a video that will explain that for you. All right, please don't forget to subscribe on this channel, share, like, comment, and be the first to receive my next video when you subscribe, and click on the notification bell. For more tips on investment finance, just follow me on all social media on Diamala Talk Finance, and I'll be there to help you as best as I can. Cheers, and always stay green. Bye for now.